The dollar was already falling when Scott Bessent walked into the Bloomberg studio. By the time he left, it had dropped another 0.5%. Traders weren't reassured. They were spooked. Because behind Bessent's calm tone was a critical concession. The August 12th tariff deadline was, well, flexible. In diplomatic speak, that's a stall. In market speak, that's a trigger. And in Beijing, they heard opportunity. Bessent's message to investors was clear, don't panic. Yet the fact that this message needed to be delivered at all exposes its contradiction. Confidence doesn't require public reassurance. And if Washington truly held leverage, it wouldn't be hinting at extensions. The reality, Bessent is boxed in. Trump's tariffs have backfired. U.S. manufacturers are cutting shifts, not adding them. And the data is already here. U.S. manufacturing payrolls fell in May to 8,000, a figure not seen since 2017. Simultaneously, industrial production contracted for the fourth straight quarter. The ISM index hit 45.8, well below the 50-point threshold that marks expansion. None of this aligns with Bessent's optimism. The decoupling theory sold to voters was supposed to bring supply chains home. Instead, it's brought prices up and output down. Take aluminum. U.S. buyers are now paying 42% more than global market rates due to tariffs. Steel is up 33%. Copper? Nearly 28%. These aren't luxuries, they're industrial lifeblood. And the Trump administration's defense for these costs, that domestic production is a matter of national security, fails under scrutiny. U.S. steel output hasn't meaningfully increased. Capacity utilization remains at just 74%. Trump says, we need to make our own ships, our own missiles. But most of the aluminum is going into beer cans, not battleships. And Bessent knows this. That's why he's now marketing the China deal as a win for the consumer, not the soldier. It's a pivot. But it's a fragile one, because the deal's structure is already compromised by its concessions. According to Bloomberg, over 60% of U.S. imports from China are now electronics, semiconductors, and machinery components. Many of them essential, not optional. And yet, the U.S. has resumed export licenses to NVIDIA for sales to Chinese AI firms. Bessent confirmed this on air, calling it a negotiating chip. But if the chip was already handed over, what's left to bargain with? Meanwhile, inflation is creeping back. The latest CPI print showed a 0.3% month-over-month increase in core goods, driven by higher input costs. Durable goods are now outpacing services in price gains for the first time since 2021. Consumers are noticing, and markets are reacting. Treasury yields are rising, but not because of growth, because of risk. And while Bessent pitches stability, Trump is rewriting the Fed's future. Jerome Powell will be replaced by May 2026, per constitutional term limits. Trump has already floated candidates Kevin Hassett, Scott Bessent himself, and Thomas Waller. All of them share one conviction: aggressive rate cuts. None of them share Powell's inflation caution. The implication is stark. A dollar under high rates and strong trade volumes can attract global demand. But a dollar under low rates and weakening exports cannot. And May's trade deficit confirmed that reality. It widened to $97.8 billion, up 10% month over month. Exports fell 6.1%. Imports were flat. The imbalance isn't improving, it's accelerating. Let's break the illusion. Because it was never about tariffs. It was about time, and Washington is running out of it. The idea that Trump can reboot U.S. industry while isolating China is failing. And not in theory, but in practice. Vietnam, Malaysia, and Mexico have picked up slack. But not enough. U.S. firms still rely on Chinese intermediate goods, components, not finished products. These aren't substitutable. A diode isn't a pair of shoes. Yet Chinese exports remain resilient. In June, they rose 3.4% year over year, even as Western demand softened. Why? Because Beijing pivoted to the global south. Exports to BRICS nations rose 11%. Exports to the Middle East, up 14%. The tariffs haven't stopped trade. They've redirected it. And while Washington retaliates with isolation, Beijing responds with inclusion. This is where Australia enters the scene. Prime Minister Anthony Albanese touched down in Beijing not with demands, but with deference. A visit to the Great Wall, a summit with Xi Jinping, and an agreement to review the Australia-China Free Trade Agreement. But behind the smiles was strategy. Because Australia isn't hedging its ideology, it's hedging its economy. China is Australia's top trading partner by a wide margin. In 2024, bilateral trade hit $220 billion. That's double the trade volume with the United States. Iron ore, LNG, gold, barley, wine. It's a list Beijing needs and Canberra must supply. And Albanese knows the clock is ticking. China is building its own mines in Africa. Diversification is not a bluff. If Beijing achieves resource self-sufficiency, Australia loses leverage. Worse, it loses income. Mining accounts for 10% of Australian GDP. But more importantly, it supports 240,000 direct jobs and over 1 million indirectly. Losing China's market would rupture those figures. Hence the urgency behind the so-called reset. Ironically, while Trump warns allies of Chinese dominance, he's forcing them into China's arms. Indonesia just signed a $19.5 billion package with the US, including Boeing jets and LNG, just to lower tariffs from 32% to 19%. Still not competitive. So what does Jakarta do? Increase Chinese imports to stay price competitive. The trade workaround is built into the tariff system itself. And that's the contradiction. The US wrote the rules of global trade. Now it's breaking them, and watching others follow its lead. When America subsidies agriculture, it's called resilience. When China does it, it's manipulation. That inconsistency no longer holds. Nations are adapting, not to ideology, but to necessity. And necessity is rebalancing the dollar. Bloomberg's dollar index is down 8.3% year to date. Treasury auctions are showing tepid demand. June's 10-year issuance saw the lowest foreign participation in 5 years. Meanwhile, Saudi Arabia has cut U.S. bond holdings by 27%. Japan trimmed by 11%. China is now the second largest holder, not the first. This isn't a run. It's a rotation. Investors are moving from U.S. paper to gold, to Chinese sovereign bonds, to BRICS-linked currencies. And with Trump signaling 1% rates under his preferred Fed chair, the dollar's real yield is projected to fall below zero. That would trigger a capital exodus, not in panic, but in precision. And yet Bessent insists that markets are in a good place. But currency traders don't trade on sentiment. They trade on spreads. And with Eurozone rates stabilizing and U.S. yields falling, the incentive to hold dollars is eroding. Add in tariff risks and policy volatility, and the greenback no longer looks safe. It looks unstable. Australia's pivot illustrates the consequence. A U.S. ally, security partner, and member of AUKUS now realigns economic policy with Beijing. Because interest isn't ideological. It's material. Albanese's visit includes talks on decarbonization tech and agricultural streamlining. The messaging is subtle. The strategy isn't. And while Washington offers submarines, Beijing offers markets. While Trump promises strength, China offers stability. And while Bessent tells investors not to worry, the numbers say otherwise. Markets are already pricing in the fracture. Commodities are diverging, treasuries are decoupling, and currencies are breaking their old rules. Before 2025, global equities fell when the dollar rose, a classic safe haven dynamic. Now they fall together. In March, U.S. equities dropped 3.8%, and the dollar followed. The signal? Investors no longer view the U.S. as refuge. They see it as risk. And the last contradiction lands here. The country trying to isolate China has isolated itself. Traditional allies are diversifying. Former partners are defecting. And economic leadership is no longer asserted. It must be earned. Tariffs were supposed to restore balance. But in tilting the board, Washington has tilted the world. So will Bessent secure a deal? Will China concede? Will the dollar rebound? These are open questions, but they cannot be answered by slogans or spin. Only structure answers structure, and right now only one side is building it. Germany's reaction adds another layer. Once one of the most steadfast transatlantic partners, Berlin has now launched an independent trade mission to Southeast Asia, skipping Washington entirely. According to the Financial Times, Chancellor Friedrich Merz told business leaders in June that supply chain sovereignty was now Germany's national objective. That phrase didn't include the word ally. It included the word independent. German exports to China rose 6.9% in the second quarter, despite falling demand in Europe. BASF and Siemens have opened new operations in Guangdong. Volkswagen has recommitted 2 billion euros to its EV joint venture in Anhui. These aren't tactical hedges. They are strategic alignments. And they contradict Washington's call for de-risking. Because when firms face risk, they calculate, not campaign. India, long considered the West's democratic hedge to China, has also shifted tone. At the BRICS Plus summit in Johannesburg, Finance Minister Nirmala Sitharaman stated that strategic autonomy would guide India's trade agenda. Not alignment, not containment, and Indian imports of Russian and Chinese goods surged by over 20% year on year. The same quarter, U.S. imports to India fell 8.4%. Brazil has followed suit. In May, President Lula met with Xi Jinping in Beijing. The two nations finalized a deal to settle bilateral trade in Yuan instead of dollars. Brazil exports soybeans, iron ore, and crude. China now buys over 34% of all Brazilian exports, more than the U.S. and EU combined. The result? A BRICS currency fund is under discussion, and dollar exposure is now a liability, not an anchor. And still, Bessent calls the system resilient. But system resilience isn't measured by volume. It's measured by control, and the data suggests that control is slipping. According to the U.S. Treasury's June TIC report, net foreign purchases of long-term U.S. securities have declined for 5 consecutive months. That hasn't happened since 2008. The last time that trend appeared, the dollar's global share dropped by 4.6%. The IMF confirms the trajectory. In their latest currency composition of official foreign exchange reserves, or COFR release, the dollar's share fell to 58.9%, the lowest in over 2 decades. Meanwhile, the Chinese yuan rose to 3.1%, and gold reserves saw their largest central bank increase since 1967. These are not symbolic moves. They're risk adjustments, and the contradictions persist. The Trump administration criticizes China for capital controls, yet the U.S. now regulates chip exports, energy trade, and outbound investment. The U.S. accuses Beijing of industrial overcapacity, but subsidizes its own manufacturing through the CHIPS Act and Inflation Reduction Act. The line between protection and projection has blurred. For others, it has vanished entirely. Japan's actions further complicate the narrative. Tokyo signed a rare minerals deal with Vietnam in June, specifically to reduce reliance on U.S. rare earth suppliers, not Chinese ones. According to Nikkei Asia, Japanese firms expect U.S. policy volatility to outlast the Trump term. That word, volatility, is replacing what used to be called leadership. And volatility is not a magnet, it's a warning. The Philippines is another frontline state. Despite deepening military ties with the U.S., Manila has expanded agricultural and digital trade with Beijing. President Marcos Jr. told reporters last month that we will not choose sides. We will choose interest. The phrase may sound banal, but in a world of competing coercions, neutrality becomes a strategy, not a void. So where does this leave Scott Bessent? In theory, he is the adult in the room, the economic technocrat holding the financial system together. In practice, he is the messenger of a policy increasingly incoherent. He tells markets the China deadline doesn't matter, yet headlines scream about it. He reassures investors the dollar is fine, while capital continues leaking from it. The S&P 500's recent rally, up 26% since April, is being driven not by earnings, but by expectations of rate cuts. And if rate cuts come from a position of weakness, not strength, then the rally itself becomes a contradiction. The illusion of strength fuels asset inflation while monetary erosion accelerates. It's a game of optics until the optics fail. And behind the optics is structure. The U.S. still maintains control of SWIFT, most global clearinghouses, and the primary reserve currency. But alternatives are now functional. China's CIPS system processed $19.5 billion in June alone. India's UPI system is now interoperable with Singapore, UAE, and France. These aren't hypotheticals. They're exit ramps. So will countries use them? It depends, not on ideology, on reliability. And reliability is increasingly becoming synonymous with neutrality. If the US continues to weaponize tariffs, interest rates, and export controls, then even its allies will seek insulation. Not rebellion, not alignment, just insulation. And that's the quiet rebalancing. Not a revolution, not a rejection, but a redistribution of trust. China offers scale. BRICS offers momentum. The US still offers infrastructure, but no longer certainty. And in a world rewired by inflation, climate stress, and geopolitical churn, certainty is the rarest commodity of all. Tariffs were supposed to be a tool of pressure. They have become a source of instability. Trade deals were framed as contests of sovereignty. They are now contests of survival. And monetary dominance was once unquestioned. It is now a question with 20 answers. So what happens next? Perhaps Bessent returns to Beijing. Perhaps Trump pushes the Fed under his thumb. Perhaps the dollar finds a temporary floor. But the architecture has shifted. And architecture doesn't pivot with press conferences. It pivots with structure. And if this trend holds, where countries don't align with China but reorient around it, then this isn't a reversal. It's a reset. One where the US is still powerful, still relevant, but no longer automatic. No longer dominant by default, only by design. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.